Hello everyone. Today we focus on exchange rates, which determine how much one currency is worth when converted into another. An exchange rate is simply the price of one currency expressed in terms of another. There are two common ways to express it. The first is the domestic per foreign format, such as the US dollar per euro. If the exchange rate is $1.10 per euro, that means you need the $1.10 to purchase a single euro. The second format reverses the relationship and shows foreign per domestic unit. For example, if the euro dollar rate is 0.91, that means $1 can buy 91 euro cents. As you know, US dollar is world currency, which means it dominates trade, finance, and central bank reserves. Dollarization occurs when a country that is not United States chooses to use the US dollar as its official currency. In macroeconomics, exchange rates are used for international comparisons. Suppose the European Union has a nominal GDP of 16 trillion euros. If the market exchange rate is 1 euro equals $1.10, we convert GDP into US dollars by multiplying. 16 trillion euros times $1.10 gives $17.6 trillion. This conversion is essential for comparing the size of different economies or determining purchasing power across countries. The foreign exchange market is the global marketplace where currencies are traded. It is the largest financial market in the world, much larger than stock markets or bond markets. In 2019, the daily trading volume reached about $5.3 trillion per day. One reason the market is so large is that every international transactions, whether involving trade, tourism, or investment, requires exchanging one currency for another. Most currencies are traded through, foreign exchange dealers, which are generally, banks and specialized financial firms. These are approximately, 2,000 such dealers worldwide and fewer than 100 in the United States. The US dollar is by far the most widely traded currency because it served as the global reserve currency and is involved in more than 88% of the all foreign exchange transactions. Just like any other market, the foreign exchange market has demand and supply. The demand for US dollars comes from foreign individuals or companies that need dollars to pay for US goods, service, investments, or travel. For example, foreign firms that buy American products, foreign tourists visiting the US, and foreign investors making direct or portfolio investments all need US dollars, which creates demand. On the other side, the supply of US dollars comes from Americans who want to exchange their dollars for foreign currencies. This includes American tourists traveling abroad and US investors who want to invest in foreign businesses or purchase foreign stocks and bonds. Foreign direct investments refers to buying or establishing a business in another country, while portfolio investments refers to purchase financial assets without managing the business. These flows determine the equilibrium exchange rate. Exchange rates are constantly changing, and these changes lead to appreciation or depreciation. A currency appreciates when its value rises relative to another currency. For example, if the dollar appreciates, it means $1 can purchase more units of foreign currency. A currency depreciates when its value falls and buys fewer foreign currency units. These movements are important because they influence trade flows, the tourism, and investment decisions. Let's compare US dollar to Canadian dollars. When the line on the graph rises, it means it takes more Canadian dollars to buy one US dollars. In other words, the US dollar is appreciating. It is becoming stronger. A stronger dollar makes US imports cheaper for Americans and makes US exports more expensive for Canadians. When the line falls, the dollar is depreciating and becoming weaker. This strengthens Canadian purchasing power and makes American goods cheaper for them. In this graph, the perspective is reversed, showing how many US dollars are needed to buy one Canadian dollars. This graph is essentially a mirror image of the previous one. When the US dollar is appreciating, the Canadian dollar must be depreciating because the two currencies moves in opposite direction by definition. In this example, as the US dollar strengthens, the Canadian dollar weakens. That means it takes fewer US dollars to purchase one Canadian dollar, signaling depreciation of the Canadian dollars. Exchange rate changes create winners and losers depending on who is buying or selling across borders. When the US dollar is strong, American consumers benefit because foreign goods and international travel become cheaper. However, American exporters struggle because their goods become more expensive overseas. When the dollar is weak, the opposite happens. US exports become more competitive globally and helping American firms. But imports and foreign travel become more expensive for US consumers. Investors are also affected because the changes in exchange rates alter the returns on international assets. Thank you for your attention.